In this webinar, we'll look at the current market scenario and what you can expect going ahead in the future. So as all of you are investors, or some of you who might not be active investors right now but want to invest sometime in the future, so quite hesitant. Whenever we speak to people, we find them that they are quite hesitant to put in money in the markets or to invest. The reason being that the markets are very volatile right now, and they have been range bound in a few months, and the returns have also not been very impressive in last few years. So people are generally wary of taking that risk. But in this webinar, we'll try to demystify why this is a good time to invest and what you can expect going ahead in the future. So let me move ahead with the webinar. Essentially, the aim of this webinar is to tell you that why markets are where they are and what are the future prospects of the market. And the third thing that you must know at the end of the webinar is how to make good investments in current market. So let me start by asking telling you why the markets are where they are right now. What is the current market situation? If you look at the current market situation, the market since the beginning of this year have largely been in a range of 400 to 500 points. At the beginning of the year, they were somewhere close to 15,000. Then they moved up to 18,500 odd in Feb, and they are again back to 15 to 16,000 levels in the last month. The reason being, let me put it this way, the reason being uncertainty at all levels. So the biggest ill that is facing the market is uncertainty, political uncertainty, economic uncertainty, and various operational and structural uncertainties, not only in India but across the world. We'll come to that part later, but right now let us look at it from an investor point of view. The Sensex returns have been negative over the last 2 years. If you look at the beginning of August in this chart, if I were to show you, in the beginning of 2010, the markets were somewhere close to here, which is 18,000 range, and currently markets are close to 17,000. So largely a negative return. The only positive returns were when sometime late in November, when markets went to its 2-year high or 3-year high of 21,000. After that, there has been a continuous fall in the markets. The markets made a bottom sometime in January of 2011, which was close to 15,000 here. And after that, they have largely been in a range of 2,000 points on Nifty, or 500 to 600 points on Nifty, and 2,000 points on Sensex. But that is between 15,000 to 17,000 on the upside, 17,500 on the upside. So why has it happened? Now let us tell you why is the market currently in the red zone. First, let us look at two factors. First, I will walk you through global factors. What are the global factors which have a bearing on the market? And then I'll come to some of the issues which India is facing on the domestic level. On the global front, you'll see that there has been a lot of stress in various countries across the world. The primary of them being the developed countries of the world, the Northern American region, the Eurozone, that is largely the Western and the Southern Europe, which is largely facing problems. In India, the growth has slowed down. The biggest driver of the growth in last few years were China and India, and both of them have seen decreased growth rates over last few quarters. Also, there has been some problem in the Southeast Asian countries. So the global prognosis is not looking very bright at the moment. Now, there has been an economic slowdown in the world's largest economy, that is the USA. This graph, as all of you can see on your screen, very succinctly illustrates the fall in growth in US. Till 2007, the growth rate in US was good, and that was the primary reason for many countries growing at a rapid pace, because they could export their goods which were produced in their own countries like China, many of the Southeast Asian countries. They could produce goods and sell it to US, where there was a ready-made and very big market for most of the manufactured goods. So US was the primary driver for this consumption-led boom across the world. But what has happened since the collapse in 2007, the housing boom collapse in USA, is that the domestic demand in US has slowed down. The unemployment rate in US has gone up drastically. The debt to GDP ratio of the country as a whole has risen. Now if you look here, the growth rate in US averaging over last 2 years has been somewhere close to 1%. If I were to draw a line, there has been some recovery in 2 or 3 months, but largely it has been close to 1%, 1.5%, even sometime going in the negative territory, as you can see here. So the growth rate in US, which was the biggest engine for growth in the world in a time period of, let's say, late 90s to mid of 2000s, that engine of growth which was driving the world growth has slowed down. In its place, China and India have tried to fill the void, but China is basically an export-oriented story and driven much by the commodities. India, on the other hand, is mainly an internal demand-driven economy. So these have not been able to take the place of US as a whole. Also, if you see the debt levels in US, the government debt in US has been consistently rising. It was fine up till 2008, but after 2008 and 9, there has been a sudden spike in the US state government debt to GDP ratio. This has been because of various monetary easing schemes, which are largely called QE1. You must have, some of you who read your business dailies regularly would have known these schemes as QE1 and QE2, which is quantitative easing. Quantitative easing loosely translate that the central government of the country prints money so that it can spur demand. But that has not taken place despite their best tries. So there has been an economic slowdown in the world's largest economy. Now let us move to what's happening in China. There has been an economic slowdown even in the world's second largest and the fastest growing economy. Since 2007, late 2007, early 2008, from the time when there has been a slowdown in US and Western Europe, China was the primary driver of the world economy, primary driver in growth in world economy. But as you can see, that after 2010 mid, there has been a fall in growth in China also. You can see that there has been not a very steep fall, but a gradual fall in China's growth rate also. So this has also led to a drag on the world economic growth. There has been decline in consumer confidence across the world, not only in US, China, whose graphs are here, and as you can see that there has been a very persistent decline during the subprime crisis and the Eurozone crisis. Similarly, in China, the same situation takes place. But not only in US and China, but across the world, there has been a very hazy outlook on consumer confidence. And as you know, when consumer confidence is low, people tend to buy less. They tend to take less risks. The primary rationale or the primary motivation that time becomes capital preservation, because they are anticipating bad times going ahead in the future. So what do? When you anticipate that something bad is going to happen, you preserve your capital for that exigency whenever it arises. So that is what is happening. Despite the best efforts of all central banks in US and sometimes even in Eurozone to spur demand by printing more money and flooding the whole economic system with money, they haven't been able to spur growth because people confidence level is low. And when your confidence level is low, you tend to focus only on the essential goods and not discretionary goods. So essential spending is there, but discretionary spending has fallen by notches in both Europe, that is Eurozone, in China, in US, and generally across the world. In India, even if you see, you read every day in newspapers that the car sales growth rate is falling, the demand for housing is falling. So why is that happening? Why is that is happening? Because people don't see a very stable outlook for themselves over next few years. Whenever people think that the outlook is going to be stable in coming few years, they tend to take debt, they tend to take more risk. But this is a time when people don't want to take that sort of risk. Now, if you see, there has also been a big crisis in Eurozone. American crisis is right now been stabilized to certain extent. We don't know that how long that scenario is going to last. But the big problem area right now in the world is the Eurozone. You must have heard about the pigs, that is with double I, P with double I, pigs countries. That is Portugal, Italy, Ireland, Greece and Spain. So these are the 5 countries where there are major problems. There are even problems in France. There are some problems in Great Britain. Perhaps the only big country in Eurozone which is not much impacted by this crisis is Germany on an internal level. But Germany has a problem because it now has to take the whole Eurozone together with itself to prevent a full-blown crisis in the whole Eurozone. So why is that happening? Because of excessive debt levels of government allied with decline in GDP. You can see right here that there has been consistent increase in debt level and a decline in GDP growth rate. Both of these have allied to increase unemployment across the Eurozone, a decrease in consumer confidence, and largely people going on agitations in Greece because they have been used to living a very gracious and a very extravagant and simple, not simple, but a very easy life. So when push comes to shove, it pinches them a lot. But that is what the situation is. Eurozone debt crisis is also a factor which is a drag on the international economy. Greece, I told you, Greece has already defaulted, and Greece is a big problem area for the whole Eurozone. Now, as you can see, the government debt to GDP levels in Greece have been very high. At the end of 2012, they were as high as 165% of the total GDP. It means the government debt was 1.65 times of the total GDP. And as you can see, for the past many months, the growth rate in Greece has persistently been negative. You can see all these negative figures. There is a fall in the GDP of Greece. So Greece has been a big problem area, but fortunately for us, Greece is not a very major economy in Eurozone. That's why the crisis has been curtailed to some extent. If the same were to happen in a big in an important country like Spain, the effects would have been very severe for the whole financial system. So Greece has also been a drag. So to summarize, the impact of global factors is a decrease in investors' sentiment, which leads to a fall in FII investments, and a decrease in export from India because countries are consuming less because of investor sentiments and a fall in consumer confidence. So we are able to export less, and as a result, the net sales and profits of many corporates which depend primarily on exports has fallen. So these are the basic major impacts of global factors. Now, what are the domestic factors? If the situation at home was very good, and no matter how pessimistic the global outlook would have been, the situation would not have been so bad. But there are many domestic factors also playing on here. What are those domestic factors? Let us look at them. The most important or the primary reason for negative sentiments in India is high level of inflation. The general comfortable range for RBI, that is the Reserve Bank of India, the central bank which regulates the monetary policy in India, is at maximum 6 or perhaps at a stretch 6.5%. That is the level beyond which they don't want inflation to go. But in last 3 years or 4 years, that inflation has remained very sticky. It has largely been above 6 to 6.5%. So that has tied RBI's hands to a large extent. It can't pursue monetary easing policies in a time of high inflation, because if it does so, inflation is likely to increase further. And as all of you, I should tell you, all of you, is that the primary objective of any central bank is not to ensure growth, but it is to ensure price stability. All central banks across the world have a mandate to ensure price stability so that decisions by corporates, by individuals, by governments can be taken objectively and with a higher degree of confidence. Because when there is no price stability, you are bound to not take consumption or investment related decisions. So inflation has remained a persistent problem for India. Most of it is purely supply driven. And what I mean here by supply driven inflation is that the inflation is not rising because of excess demand, but lack in supply of goods. For most goods, whether those are agri commodities, whether those are capital goods, the supply isn't keeping pace with the demand that is there. So most of these can be removed by increasing or improving our infrastructure. They can be improved by increasing productivity. So these are the basic reasons for high inflation. It has remained above RBI's comfortable maximum range. Right now it has fallen and it has shown some chances of falling. But again, if we really do have a bad Kharif crop season, which is the summer crop season, again inflation, especially food inflation, which is politically very important, is likely to go up. And if food inflation goes up, then again government's hands are tied, because 2014 is likely to be an election year, or barring some political uncertainty, we might even see election towards the end of 2013. In that case, if food inflation goes up for the current government, that's a very undesirable thing going into the elections. Okay. Now, second is high interest rates. That is a corollary which flows directly from high inflation. Because inflation rate is high, RBI's hands are tied and it has to increase its interest rates. As you can very well see, during the last crisis in 2008, RBI gave some leeway. It decreased rates sometime in 2009 end to 2010 beginning. But when inflation reared its head again, RBI has continuously hiked rates for 19 consecutive months. There has been some fall in CRR, etc., but those are token measures. The real interest rate has been decreased only one time in the past, and it's not likely to come down to 2010 levels, beginning of 2010 levels when it was 4.25%. It's not likely to come down to those levels sometime in hurry. So that is a direct corollary from high inflation, because we have high interest rates. And when you have high interest rates, companies which have taken debt need to pay more amount on to service that debt. And when you have more amount, when you need more amount to service that debt, then your profitability is hit. It even plays a part in investments. If a company wants to invest in new projects, it has to take some debt or loan from banks and financial institutions. And if the company knows that the interest rate environment is on the higher side, the company is likely to delay its investment. So it's a sort of double whammy. It's sort of a chicken and egg situation. If you reduce inflation, then only can RBI increase interest rates. But in a increasing inflation environment, in an inflationary environment, if RBI tries to decrease interest rates too much, it will again stoke up the inflation. So this is a rut in which we have got into, and we need to come out of it by taking some broad policy based initiatives, by spurring investments into productive sectors, by increasing our productivity. These all will lead to a fall in inflation, which will ultimately lead to lowering of interest rates. Now, again, something which flows in from the previous 2 points which we have discussed, an increase in inflation and an increase in interest rates has led to a decline in IIP, which is Index of Industrial Production. Basically, it indicates the economic activity has dwindled in the country, which is understandable because in times, as I explained to you earlier, in times of increasing interest rates, the investment is likely to slow down, because corporates need to pay higher amount of service on their debt. Again, a problem with IIP also is that we'll come to that point later, but if I have to give you a brief, is that the government policies have been very erratic in nature, and there has been no policy initiative which has been announced by the government which can spur investments. So that has also led to a decline in index of industrial production. And as there has been a decline, it generally has a domino effect across sectors. If BHEL is not producing machinery, then new power plants are not being set up. If new power plants are not being set up, then there is an electricity deficiency. If there is an electricity deficiency, new FMCG plants or textile plants don't come up. So once that happens, it has some effect all across the companies. It's a sort of domino effect, if I were to say. If something goes wrong, then it impacts other things also. Another thing has been a huge government profligacy in past few months. The government has been spending like there is no tomorrow, and it is not keeping any sort of financial or fiscal discipline. This has led to high current account deficit. A major contributor to this has been increasing crude oil and gold prices also. As there has been a risk off trade across the world, if I to say. By risk off, I mean that the investors are not willing to take higher amount of risk, because as you know, equities out of all investment class carry the highest returns, but along with it, they carry higher risk. So at this point of time, people are thinking of parking their money in safer things like gold, for example. And as you know, that India is a large consumer of gold. And most of the gold isn't produced in India, so we have to import it. So increasing gold prices means higher amount of imports. All of you are also aware that we have insufficient crude or gas in our own country. So again we import those, and increase in prices of crude again has led to a very high amount of current account deficit. How current account deficit impacts us? It leads to a higher US dollar Indian rupee exchange rate. That means rupee has become cheaper. Cheaper in the sense in terms of value. In absolute terms, rupee has become expensive related to dollar. Earlier, sometime back, one year back or so, you needed to pay only 45 rupees for every dollar. Now you have to pay 56. So that has been a drag. Why it is a drag? Because as we are importing, we need to bear a higher rupee cost of anything. So that has also been a drag, the current account deficit. There has been a drastic decline in India's GDP growth rate because of all these previous mentioned factors. As you can see very well that from a high of 9.4% in 2010 beginning, the GDP growth rate has fallen to 5.3% in the last month. Again, that is mainly because of all the factors, that domestic factors that I have outlined to you before. There's not enough investment taking place, the inflation is high, the interest rates are high. So all these have a bearing on one another, and there has been a decline in India's GDP growth rate. Incidentally, when there is a decline in GDP growth rate, the outside money, the foreign money which wants to invest in the company, that flow also slows down. So there has been a slowdown in FII investments in India. And perhaps the biggest and the primary reason for all this has been complete government policy paralysis. The government has just ceased to function. It is in a complete coma right now, and it doesn't seem to be coming out of it any time soon. It has taken no worthwhile policy changes which could have spurred investments. It has done nothing at all. The government has been so tainted by corruption scams in the past few years that it is hesitant to even take one step forward. And whenever it takes one step forward, it generally takes 1.5 to 2 steps backward. So there has been no impact. There has been delay in FDI in multi-brand retail. There has been delay in FDI approval in aviation, insurance. There has been delay in implementation of goods and services tax. Perhaps this was the most important thing which could have helped us. But there has been a complete lackadaisical attitude from the government, and they generally are in a state of limbo, not knowing what to do. There has been a delay in implementation of direct tax code, which could have rationalized the tax structure across and would have led to more revenues for the government in form of taxes. There has been no consensus to reduce subsidy burden because diesel is being sold at a price much below at which the oil companies get it, which has led to again a stress on finances, which again leads to higher current account deficit. It spurs inflation also. So government hasn't shown any willingness to do anything in many months, or perhaps I can say years. The basic or perhaps the primary reason for this is complete failure of this incompetent government that we have right now. It has also tried to pass some legislations like GAR for funds which are routed through Mauritius, which has again led to a negative investor impact or sentiment. There has been incidentally delays in clearance of many projects, especially power and mining projects. The companies have found it very difficult to access land and labor, and the government has done nothing to fast track any projects. The environment laws are quite hazy. The labor laws reforms are still stuck somewhere in the government. So there has been a complete policy paralysis and a policy making failure on the part of the government. How does this impact us? This graph very succinctly explains everything. High inflation will lead to lower demand and increasing RM cost. Higher interest rate will lead to higher cost of debt and decline in domestic consumption. Everything that I have explained to you right now, this graph very succinctly, or this image very succinctly puts all that together. So basically the biggest problem here is this, and if I were to say the second biggest problem is this. So until and unless government moves on these two concerns, it's very difficult to get India back on a sustained path of 9% plus growth. So after all the ideas about the current and the current domestic and international markets, what are the future prospects for the market? Because all of you have joined this webinar as investors, and would be willing to know that if you invest money right now in markets, would it be very risky? Would you get lower returns? That's a very common apprehension amongst all our investors. They are not willing to take risk at this time. They are generally on a risk off mode. They are hesitant about the future prospects of the market. But let me walk you through last few slides, and then we'll see whether it is a good time or not. In short term, we expect that Indian markets would remain volatile until and unless there are some big global factors and a complete policy paralysis on the part of the government and inflation remains sticky. In short term, markets will remain volatile. They are likely to show sharp up moves and sharp down moves within that range. Excuse me, that range of, let's say, 14,000 to 18,000, there would be that would be the short term range for the markets until and unless there are some major events taking place in India or across the world. That range of between 14,000 to 18,000 is likely to be maintained. There is uncertainty about monsoons also, incidentally. In these dire times, though monsoons have picked up in late July to early August across India, still we are yet to know what will be the impact on kharif crops across the country. If kharif crops are normal to even, let's say, mildly below normal, then it won't have much of an impact. Our channel checks across India incidentally indicate that the situation is likely to be below average but not very bad. So that is some consolation that towards the end monsoons have picked up. So in short terms, broadly you can expect by short term here I mean that in coming 3 months or at a maximum 6 months, the markets are likely to remain in that range and they are likely to be volatile. There will be no clear direction to the market as such until and unless some very significant domestic or international event takes place. What about companies? What do companies generally do when such an economic environment faces them? They try to protect their profit because economic slowdown generally hurts sales and profits of businesses. So corporates in such an environment generally shift their focus from increasing sales growth to increasing their margins, that is the profitability of the companies. How they do it? They do it by lowering debt and by improving their cash flows so that they can hold more cash for uncertain times. They also cut down on their operating expenditure and they do it by reducing further investments. How can they cut operating expenditure? By reducing employee cost and reducing spend on sales and advertising. And incidentally, all of these factors have a domino effect. So until and unless you control inflation and take some very positive policy measures, coming out of this cycle would be difficult in the short run, that is coming 3 to 6 months. But all these things help a company to improve its profitability even if sales decline. So let's say earlier if a company was having a sales of 1000 crores and its net profit margin was, let's say, 10%, it would have made a profit of 10 crores. Now what a company will do is, if on a sale of 1000 crore and a net profit margin of 10%, if your profit was 100 crores and let's assume that due to economic environment the sales fall by, let's say, 10%. So from 1000 crores they come down to 9000 crores. And if I increase due to these various initiatives my net profit margin by, let's say, 10 more percent, from 10% my net profit margin goes to 11%. What happens in that case? In that case, my net profit is 990 crores. So in effect, if my sales has fallen by 100 crores, my profit has only fallen by 10 crores because I'm increasing my net profit margins. So in such an environment, companies generally look to increase their margins or profitability. But that was about the short term. What about the long run? If you want to invest for a horizon of, let's say, 1+ year, 1 year, 18 months, 24 months, what do we foresee in the long run? In the long run, again, we foresee that despite short-term aberrations, Indian market is expected to give good returns. This is because though Indian growth has slowed down, it is still amongst the highest in the world. So, in absolute terms, the growth has slowed down, but in relative terms, the growth is still robust. And if such a situation takes place, generally in coming 7 to 8 years, India will be the 5th largest economy in the world. In long run also, Sensex is driven primarily by corporate earnings and not by economic environment. Even if economic environment is weak and companies are able to grow their earnings, the Sensex will perform better. Even in a pessimistic scenario, let's say a pessimistic scenario where India grows at, let's say, somewhere between 6 to 7%, and companies increase their earnings every year by, let's say, somewhere between 10 to 15%, the market should give you returns of 10 to 15% at least going ahead. History also tends to repeat itself. Sensex generally recovers after every crisis in the past. So investment in equity is largely a play on the economic future of the country. If the country is going to do well going ahead in the future, the Sensex will also follow the line of the country. As you will see that Sensex is largely at a discount. We'll come to that concept later on in the slide. India is expected to be 5th largest because of heavy infrastructure investments. The government has made some promising noises after P. Chidambaram joined in as the new finance minister. And the government is promising to do something on that front. Because ultimately, even in politics, you need to do something to the populace of the country to get votes. If the government stays in the state of limbo that it currently is in, it is much likely to be vanquished in the next elections. So the government is also likely to move ahead with some investments in infrastructure, which will generally have a good bearing. Once these infrastructure investments start coming in, there will be increase in capital expenditure, there will be generally an increase in order flow to companies, which will translate into net profit for companies. It will also lead to an increase in consumer demand. Because if you are laying a track, let's say I lay a railway track from place X to Y, this what happens? I give orders to some companies, then I require some labor to build that tracks. That labor will have demand of goods in form of clothes, food, housing. So all this again leads to a domino effect, but a positive domino effect. It doesn't lead to a falling of cards, but it leads to a very positive multiplier effect across the country. We expect some major economic reforms to be announced in coming 2-3 months, the impact of which will be felt in coming, because the government as of now doesn't stand a choice. If it does nothing, it will go into the dustbin of the history. So it's better to do something and fail rather than do nothing and fail. So the government might as well, not very contentious issues like retail, FDI or such, but definitely some increase in infrastructure spending, FDI in aviation, the government, more clarity on various tax structures, GST, that is goods and sales tax, is likely to be implemented perhaps in the next budget. If it can do all these things, it can spur demand. The inflation bottlenecks due to supply side constraints can be addressed, and that will be a positive for the country. India incidentally also has very favorable demographic changes. In some year, India is likely to overtake China in terms of population, but most of this population is likely to be young population. So if there is ample opportunity, India is likely to benefit immensely, and that is perhaps the single most important driver. What government needs to do is to create policies and systems and ecosystem in place which can harness the energy of the youth of the country. It will also lead to things like growing urbanization, people moving from villages to cities, change in consumer lifestyle, and increasing disposable income. So if government is even able to do some things right, India can easily go back to 7% plus growth rates. And if it does many things right, we can easily go back to having 8 to 9% growth rates. If you look at the Sensex PE and our Sensex at MRP thing, the general PE, average 10-year PE of the Sensex has been 18.20 over the last 10 years. Currently, the Sensex PE, that is price to earning of the Sensex, is 16.73, which leads to a valuation of 17,000. But ideally, even at a 10-year average PE, it should be at 18,500. So despite short-term glitches being there, the long-term prognosis for the Sensex or even the Indian economy as a whole isn't so bleak. We feel that because we have gotten used to 1 or 2 years of 8 to 9% plus growth rates. But let me tell you, even at 6%, India is one of the largest growing economies in the world, and other economies have fallen more drastically than India. We also need to see that what history tells us. History tells us that whenever there has been a slowdown, a fall in Sensex over a small to large period of time, there has been a strong recovery in coming years. For example, in 91, when there was a balance of payment crisis and India had to pawn its gold with the UK to get money, Sensex was at 1168. But 3 years succeeding that crisis, Sensex was at 3800, which gives you an annualized return of 48%. Again in FY01, that is 2001, there was a dot-com bubble and Sensex again fell to 2800 levels. But in 2004, it again rebounded to 5500, 5600 levels. Similarly, in 2009, the subprime crisis engulfed the world. Sensex fell to 9,000. It even went as low as 7,000. But for sake of our calculation, even if we take a figure of 9,700, in FY11, Sensex went up, or currently the Sensex is close to 17,000 levels, which is again a plus 20% plus sort of return. So in adverse times, the valuations are low and investment opportunities are high. We keep on repeating that there are various perils of investment wisdoms by various investment gurus. One says buy at the time of highest pessimism and sell at the time of highest optimism. So this is the time when pessimism is highest. You are wary of investing, you are wary of taking risk, but people who venture into the market right now will find that there are many attractive opportunities, and those are the people who will be laughing all the way to their bank in coming 3 to 5 years. So if there is a right time to invest, that is now, but it has to be done with keeping a time horizon of more than let's say 2 to 3 years in your mind. If you want return in 2 to 3 months, then you might better opt for other schemes. But if you are an investor who is willing to take risk, who is willing to be patient, who is willing to be safe, because our system cuts down on your risk and gives you safer stocks. So we'll come to that later, and you will make a good amount of returns. We also have a tool called Sensex at MRP. At the end of 26 June, the Sensex was close to 17,000, and our own internal analysis told that the fair value for the Sensex should have been close to 20,000. So Sensex was trading some close to 15% below its ideal or intrinsic value. 26 of the companies in Sensex were below their intrinsic value. We use a tool called MRP, which indicates the intrinsic value of the company. So there are 26 companies below that, and only 4 companies were above their MRP. So that meant that there was ample opportunity to invest. So considering all these things, low valuations, favorable long-term economic prospects, despite them looking very dull at the moment, we believe that there are ample number of opportunities, and you can use our system, the Money Works For Me system, to get the knowledge about those investment opportunities and invest in a phased-wise manner over the coming uncertain times in, let's say, current next 2 to 3 months, and be invested for a period of 2 to 3 years, and you are sure to do well in coming times. If I were to give you certain good investments, even if we look, even in these adverse situations, if you would have used our products Nifty 50 Superstars, you would have been able to pick up many gems like Asian Paints, which in August 2010 was at 2600. Now in 2 years it is at 3640 and an annualized return of 18.3%. Similarly, ITC, Hindustan Unilever, Tata Consultancy Services. So it's not that even in adverse scenario, there are a few stocks which will deliver excellent returns. And if we see that in coming years, next 2 to 3 years, when situations are likely to improve, there will be a large number of such stocks. You just need to be disciplined, you need to be focused and do your homework and use our system diligently, and you will be able to find many such stocks. We do various webinars on how to invest safely, and I'm just letting you walk through a few of these things. You should generally, in such a scenario, avoid high debt companies, invest large percent of your portfolio in large caps using products like Nifty 50 Superstars. You should invest in companies which have a very good or a high moat, which is a sustainable competitive advantage for a company. You should invest in companies which have consistent financial performance, which you can know by looking at our 10-year X-Ray Pro. You should always follow stop loss system, which we have explained in various webinars. And in case some of you are new, you must try to attend some of our forthcoming webinars on safe principles of stock investing. You should always buy stocks at a margin of safety. Incidentally, some of you who are users of Money Works For Me know the concept of MRP and DP, and some of you who don't know can look up on our website or attend our forthcoming webinars on such topics to know that how using margin of safety can help you and deciding when to invest. With this, I thank you all of you for patiently listening to me. Now the floor is open to question and answer sessions, which I'll take over a period of next 10 to 15 minutes. I'll try to pitch in with as many questions as possible. Okay. Just let me take a 1 minute break and I'll come back to you.
Yeah, Mr. Shaurya just required a glass of water. He'll be back in a minute.
Okay. So I'm back after refreshing myself after a sternus exercise. Now Parag asks, why FMCG and pharma sector stocks grown in 2 years? Last 2 years, I hope, Parag, that I have got your question correct. Basically, the reason is that FMCG or pharma companies are companies whose demand of goods is rarely likely to decrease. For example, if you consume some food, you will consume the same amount of food. If you require medicines, you will require medicines even if there is a slowdown. So these are sectors which are not discretionary spending sectors. These are essential commodities. So FMCG and pharma companies have grown because they produce goods which are essential in nature and not discretionary in nature. Discretionary goods can be recreational goods. For example, if I have to give you an example, let's say gaming companies, or if I have to give you another example, let's say buying a car. Buying a car is a discretion. You do it when you have enough money to fund for it, the car, you can pay off the EMIs. That's why auto companies, for an example, haven't done so well over last few years, because the discretionary spending by people has gone down. But why FMCG and pharma have done well? Because they produce goods which are essential in nature. You need them. So that's why these sectors or companies in these sectors have done well. Second question is from Manish Shah, who asks that GDP is eyewash. Should see PPP. That gives better picture for any country. Yeah, that is quite correct. Even in purchasing price parity terms, India is still doing well enough for itself. So that is whenever we say GDP, we generally tend to take absolute GDP because it takes out the foreign exchange fluctuation out of picture. So the comparison across various years or cycles becomes better. If you are to compare quality of lifestyle in countries, then purchasing power parity is a very good indicator. But if you are comparing country X with country Y over a period of 10 years, there would have been wide fluctuations in exchange rates. So that tends to distort the data a little. So that's why we look at GDP. But be assured that whenever you need to look at the quality of lifestyle or the amount of money a citizen of a country has, then we look at purchasing power parity. Because a person with a daily income of, let's say, $20 can survive excellently in India. $20 incidentally means more than 1,100 rupees. And person can easily survive in India. But if you are able to, if you are to get $20 per day in USA, or in, let's say in Switzerland, it will be very difficult for you to survive. Now Suhas asks, inflow of $11 billion in 2012 till today in our markets have made valuations high, which are fundamentally not in line. Do you agree to this statement? Basically, you'll have to look at inflow across years. This has been an year when a very less amount of inflow has been there. $11 billion for a huge market like India is like peanuts. There has been approximately a large amount of outflows also, and the net inflow is close to $10 to $15 billion for 2012. But these haven't driven up valuations. As in a slide, I showed you that 10-year average PE ratio for Sensex was close to 18. Currently, it's close to 16.5. So valuations are still below their long-term averages. So still there is some way to go up. Now, Gregory asks, in spite of all policy paralysis, why is stock market not falling? Stock market is not falling because it is in an undervalued territory already. If there would have been no policy paralysis, there would have been some policy movement, the market would have risen for sure. But in policy paralysis, market is not falling because companies have been able to maintain their earnings to a large extent, and policy paralysis hasn't led to a decline in the EPS or the profitability of the companies. So as long as companies are able to maintain their profits, just a second. Yes. So as long as companies are able to maintain their earnings, the market has less room to fall down because it is already in an attractive valuation territory. So the thing is, once this policy paralysis is removed, the markets would rise. Now Shishir asks, are the government financial advisors sleeping? Shishir, I guess you already know the answer, and there is no need for me to explain. I've already told in very certain terms during the presentation that the government is completely devoid of ideas. It would do very well for all of us Indians to do something and do it fast. Now Dilip asks, what is about Nifty 50 Superstars? Okay, Nifty 50 Superstars is one of our products wherein we offer all the advisory, including the 10-year X-ray analysis of the company, including the intrinsic value or the MRP of the company, the discount price, getting the right timing signals, when to buy into the company, when to sell into the company. For all companies which are in Nifty 50, ideally this happens to be a very good choice for investors who want the safest of safe sort of recommendations, or investors who are new to investing. So ideally that product caters a lot to new investors. I'll just show it on your website. This is how Nifty 50 Superstar page looks like. So if you are a paid user of Nifty 50 Superstars, you get info on all Nifty 50 companies. So if I were to look at the details of BHEL, for example, it shows you everything about the company. It has also shown a timing signal. We show everything. Now if you want to see 10-year X-ray of BHEL, you can look at that. If you want to read on BHEL, you can look at that. So this is what Nifty 50 Superstars is all about. Nifty 50 Superstars is a very product which is intended for investors who want safer stock investing, who want to invest in companies which are strong, which are consistent, and which are likely to deliver good returns over long time horizon. So all of this can be done. Even if you want to look at the company prospects, future, short term and long term, even if you want to read about the company, what the company does, how it makes profits, what is its future like, so you get info on all these. So this is about it. Now Suhas asks, should we wait for entry? Can we really outperform markets in future? Shishir, the thing here is that if you are an investor right now, you should look at stocks and not market as a whole, because there will be some companies which will perform very well in the current market scenario. There will be some companies which won't. So you should not wait for entry. You should use our system and look at the alerts. For example, if I had to go at Nifty 50 product, which I was explaining right now, and you will see, if you see our Nifty products, it will tell you which companies to buy. For example, there are 3 companies which you can consider buying in the current market scenario. Out of these 10 companies that you look at, there are a few companies which you can consider buying at this moment. And would you likely to outperform? As I showed you in the last slide, Asian Paints, ITC, I gave you examples, TCS. There are many companies which have outperformed. So it's possible by a judicious selection of stocks to outperform even in the current scenario. I hope this answers your question. Now Adhi Narayan Murthy asks, when we say short term, what time period we are talking about? Whenever we say short term, we are generally talking about a time period of coming 2 to 3 or at maximum 4 quarters. In any case, it's less than 1 year. And whenever we are talking about long term, we are talking about more than a year. So I hope that answers your question. Now Prakash Hegde asks, FII money in last 1 to 2 weeks irrespectively of domestic international problems, what is outlook for next 1 month? Generally, Prakash, giving an outlook for 1 month is a very difficult task. It is just like a game of chance. But in coming 1 month, there are no major international events lined up. So you can expect a range bound market until and unless some major announcement is made either by our government or some other problems or some positive news flows in from outside India. Now Ishwaran asks how to calculate Sensex at MRP and Sensex PE. Sensex at MRP is basically calculated by using our MRP of various companies and then multiplying it by the factor or the what you can call their share in the Sensex, and then we use it to calculate Sensex at MRP. The Sensex generally uses its floating market cap, free flow market cap. So generally, for every individual company, there will be some component which will contribute to the Sensex at MRP, and then sum together all those components to get a complete Sensex at MRP. Sensex PE is similarly calculated by taking average PE and then weighted average of all those PEs of various companies. So you look at the EPS of a company, you look at its weightage in the Sensex, add all of them together, divide it by Sensex value to get the PE ratio for the Sensex as a whole. Now the perhaps last question, because we are running out of time. I'll take a last question which is from Suhas. He says, can one consider liquidating portfolio built in 2009-10 valuations which is running in red and re-enter the market at this level? Basically, Suhas, it depends on what stocks you are holding. So if you are holding, just go to our site and check whether the stock is green, what's its MRP is like, what are its future prospects. If you see that the stock is good, then you can consider holding on to those stocks. But some of the stocks in your portfolio for whom the future is not likely to be good, with the stocks which are below their DP, companies which are red and are below their DP, you will do better to avoid those companies. Do we have time to take one more questions? Okay, the last question that we'll take is, there are sector related queries. What sectors are good for investment? Future outlook of various sectors. This is a very broad question to say, but the sectors which, and it depends on your time horizon. If you're looking at a time horizon, a very short time horizon of less than 1 year, then you'll be better off by investing in defensive sectors such as FMCG or pharma. There are few good companies which are below their MRP in these sectors. So for a very short duration, these sectors will be good, and I'll say to you that in a very short run, it will be prudent for you to focus on stocks rather than sectors, because there will be some stocks even in a bad sector, currently a sector which is doing very badly, for example, real estate, which is doing very badly as a sector. But there will be some good opportunities even in real estate sector, companies like, let's say, Mahindra Life Spaces. So there will be some opportunities. So if you have a very short time horizon, you will be doing better to focus on stocks and not sectors. But if you have a time horizon which is more than 2 to 3 years, you do very well to look at banks. You will do well to look at autos, where the demand has been depressed purely due to policy paralysis of the government and economic factors. Whenever the economic factors or the economic situations in India revive because of government intervention and inflation slowing down, the first sectors to benefit will be the sectors like banks, autos, capital goods. So if you are a patient investor, you are a long-term investor, these are the sectors where the largest amount of opportunities lie. So that is about the webinar. Now I'll thank you all of you for taking out time and attending the webinar.